In the last two installments of my series on the death of the Singapore dream, I've spoken about the difficulties of actually executing a conventional retirement plan. And then I went on to speak about the FIRE movement, the financial independence and retire early movement, to actually demonstrate to people what you can actually aim for if you want to actually find out what could replace the Singapore dream. So in this current installation, which is part 3 of my series, I will be talking about building a core portfolio with exchange traded funds. Alright, yeah, and so in this episode, we will actually get down and dirty, right, on how to actually build a portfolio that could actually credibly serve as something that could power your journey towards financial independence. Okay, alright. Alright, and so previously we've learned that the idea is that you can live on part of your investment returns, right? And you should be able to unlock more choices in your career, okay? And what a lot of young people want to do these days is to slow down or even make that career choice that you've always wanted, right? And so in order to do so, after you figure out how to earn that money on your day job, how to save that money, the next thing you want to do is to figure out how to invest your money, okay? And so what I'm going to do for this video is that it will demonstrate a very simple and very possibly the most basic approach towards building an investment portfolio that can be done by just buying 2 counters. And so for today, right, for my overview, I'll be talking about building a simple core portfolio with exchange traded funds. I'll be discussing trading infrastructure, what you need to actually get started. Then I'll be talking about this thing known as the cone of retirement, alright, which is something a little bit more hardcore about how do we simulate retirement portfolios. Then I will explain what is an exchange traded fund. And then I will talk about 2 complementary asset classes, which is equities and bonds. Then I will talk about building your core portfolio. Alright, so without any further delay, let's talk about setting up your trading infrastructure. Now, the first thing you need to get started is a simple brokerage account, alright? And the simplest brokerage account can come from any custodian-based brokerage account that can facilitate trading in the US markets at a very low fee, close to, for example, $2.50 a trade. Alright, so before signing up for any of these custodian-based accounts, right, you need to have your SingPass account. You need to have your latest bank statement for verification purposes. You need an email address, obviously a phone number as well, so that they can verify your identity. And I think the best practice is to make sure that you have about $2,000 to get started, because sometimes in the case of some of the brokers that you have, if you're willing to inject a little bit of money, they can expedite your account opening, okay? And of course, in order to allow all this to happen, you need to be quite savvy with online banking before you can attempt this. So you should be the kind of person, you know, that goes into your online banking account on a daily basis to actually check, you know, how much money you have. Right? You need to be that kind of guy, all right, before you can actually do this. I don't have a preference for an actual broker, okay? You can use interactive brokers, Futu, Mumu, all the latest very competitive discount brokers that have already come and set up shop in Singapore. But if you're curious about which broker I use interactive brokers, all right, because they have a very reasonable margin financing arrangement with local shareholders, all right. But generally, whatever I talk about, I'm agnostic to the kind of broker that you should have, all right. Okay, now the next thing I'm going to talk about, once you take your time and you set up your infrastructure, is about financial basics. And because we're getting into investments, you really need to understand what the basics are. And in the case of almost everything I teach, it begins with an understanding of risk versus returns. All right. So when it comes to thinking about returns, returns can come from capital gains or dividends. All right. So if you have a portfolio of $10,000, all right, and you manage to sell it at the end of the year for $10,100, and it's produced $500 in the meantime, then you've earned about $10,600, and so your return will be 6%. All right. When we design a strategy, we want the returns to be as high as possible. All right. That's not controversial. Now, the next measurement is going to be a lot more complicated. Risk measures how volatile or how much your data points can deviate from your average return. So this is normally measured using whatever we learn in statistics class, called a standard deviation, all right, or semi-deviation. Now, the higher the risk, the more your returns deviate from your average. All right. So even though local stock markets, you can get 6 to 7% a year on average if you invest for the past 20 years or so, you will find that in an actual practice, you can earn 20% a year, and you can also lose 8 or 9% a year. That's par for the course, right, for retail shareholders. So when we are actually trying to build a strategy, we normally try to maximize our returns, but we want to minimize our risk. All right. And the reason why we want to minimize our risk, okay, can be illustrated through my next slide, where I talk about the cone of retirement. All right. Now, this is a more interesting concept because every attempt to retire with an investment portfolio is basically a bet on a portfolio with an underlying risk or return, right? But what we are actually trying to do is that using a computer, we can simulate a multiverse, right? Imagine 500 replicas of an investor basically participating on the same portfolio. And over time, if you simulate the movement of these 500 investors, you will find that after 10 to 20 years, some will succeed in their retirement planning and some will fail, right? Now, the trajectories of these portfolio values will basically create a cone, right? Because there are 500 simulations, you create a cone. And basically what strategists are trying to do is to tweak this cone so that you maximize the probability of successful retirement. Okay, so that's what the cone of retirement is all about. And if you're able to write computer software using, for example, the Python programming language or the R programming language, you will be able to see that the probability of failure, in other words, the number of people that fail to retire, will decrease when the returns of the underlying portfolio increase, right? In other words, if you can design a portfolio that gives you a higher return, obviously you have a much greater chance of succeeding in your retirement journey, all right? So that's basically what the cone of retirement tries to tell you. But more interestingly, right, okay, if you were to increase the volatility of your underlying portfolio, your failure rate goes up as well, right? And this explains the reason why, okay, there are a couple of things you need to do when you're trying to build a retirement portfolio. First, okay, investors always gun for higher returns or lower fees, all right? Higher commissions always lead to a lower probability of successful retirement outcomes, right? And if you were to actually look at the risk, right, okay, even if the returns were to stay constant, right, you will find that by increasing the underlying risk of the portfolio, your failure rate goes up as well, which means investors should also try to get the same level of returns, all right, from a much lower risk, all right. And this is why recently you find that the financial advisors who got investors into these risky tech stocks in China and the US prior to the Federal Reserve raising the interest rates are not doing their clients a favor, all right? And this is something that you can observe from the people that actually have been like hanging around the investment chat groups, okay? And this is actually happening real time, okay? All right, now, once we have a discussion on risk and return, the next thing we want to do is that how do I get data? How do I get data on the risk and returns on some of the tools that I have, all right? And one way of doing that is by going to a website known as a portfolio visualizer. All right, yeah. So you can actually examine the risks and returns of some of your investments in an online tool called Portfolio Visualizer. You can just follow the link that I have on this particular slide, okay? And then after that, you can actually go in, key in your exchange traded fund ticker symbols, and it will automatically give you the risk and return of the funds that you're trying to look at. All right. Yeah, I might be getting ahead of myself, but I think it's time now to then discuss what is an exchange traded fund. All right. Now, an exchange traded fund is a collective investment scheme that allows you to own a diversified portfolio of stock counters. So when you buy an ETF, you're not buying an individual stock. You're actually buying like 30 to 40 stocks at the same time, all right? In the case of the STI ETF, you're buying 30 stocks, okay? But what ETFs are designed to do is to enable passive investing across multiple stock counters, right? The cheapest ETFs try to mirror the movement of an index fund, and fees can be as low as 0.2% a year. Now, one example of the ETF, as I've mentioned earlier, is the SPDR Straits Times Index ETF from State Street Global Advisors. Okay, and so buying one ETF allows you to own all 30 stocks in the Straits Times Index at a fee of 0.3% every year. Now, let's talk about what your core portfolio should consist of. Okay, now the simplest way to build a portfolio is by getting into two key asset classes: equities and bonds. All right, equities is when you're buying and putting yourself as a shareholder to participate in any upside, right, behind the business entity. All right, we do this when we buy stocks and we own ownership of a company. Okay, equities tend to do well in every part of the market cycle except recessions, and over a very long period of time, it returns about 6 to 7% after inflation. Okay, so that's the magic of equities. They tend to reward you for the kind of risk that you take, right? The problem with equities is, of course, it's got a higher volatility, right? And in periods of recession, it can actually lose you money. Now, bonds, in that sense, are the opposite of equities, because when you buy an equity, you're becoming an owner of a company. But when you buy a bond, you're lending money to the company, all right, for an interest. So bonds have a tendency to preserve your wealth in a recession and would make a good complement to a stock portfolio. Now, the downside of bonds is that over a very long term, it doesn't earn a lot of money, 1 to 2% over a very long term. And generally, you add bonds to a portfolio of stocks to improve its diversification. All right. So one very simple way of actually building a portfolio over time is to simply build a portfolio of global equities and global bonds. Right. So if you get an ETF that covers stocks from all over the world, you're done with equities, and you combine it with an ETF that owns bonds that come from all over the world. All right, when you combine it together, it becomes a very simple core portfolio. In fact, the simplest that is possible. And if you're able to build a portfolio like this, the good thing is that you don't have to monitor the stock market very often, and it allows you to focus on your career moving forward. Okay, so now let's get into some detail on what then is a global stock and bond ETF. All right. Okay, so if you, like me, I use Interactive Brokers or any broker that have access to the US markets, you can buy one global equity and one global bond exchange traded fund, right? This is very simple, okay? And I'm just going to offer you a sample of one equity ETF and one bond ETF. Now, it's not a recommendation to actually buy this because this is just something that you can possibly consider because it is very popular ETF, it's very large, and the expense ratio is very low. All right, so if you want to consider getting one equity exchange traded fund, you can consider the Vanguard Total Stock Index Fund. This is a diversified ETF that covers stocks from all over the world. It's got a super low expense ratio of 0.08%. It yields about 1.65% a year. All right. The only downside is that it is American and you're buying it from the US stock markets. So the dividends are taxed at a 30% withholding tax. Now, similarly, Vanguard also has an equivalent world bond ETF with a code BNDW. This is a diversified ETF that covers bonds from all over the world. Also very low expense ratio of 0.08 because they are fixed income. They yield about 2.73% a year. All right. So just remember that there are withholding taxes, and very simply, to build your portfolio, you just buy them in a 50-50 ratio. So if you have $10,000, you put $5,000 into your equities ETF, $5,000 into a bond ETF. All right. Okay, now let's look at some of the back-tested returns of a 50-50 portfolio. All right. And if you were to analyze the historical performance of this 50-50 portfolio, you see that it actually has outperformed our local stock market. The annual return is close to 3.2% since 2018, with a downside risk of close to 10%. So actually it's a very, very stable kind of portfolio where in the worst case, if you end up with 1 year out of 40 years, right, and you get the worst performance, you can expect losses of 17% in that particular year. So actually a 17% loss is actually quite normal, right, in the year in the stock markets. So it makes this a very, very safe portfolio that is very friendly to retail and casual investors who are into long-term investing. All right. Now, do note that 3.2% looks very low, okay? But just remember that we've just gone through a period where bonds are suffering due to rising interest rates. And this 50-50 combination, right, was actually earning 7% right up to March 2022. Okay, so there should be some room for better performance once inflation gets tamed this year or next year. All right, yeah, and so generally this sums up how to build a core portfolio. All right, 2 ETFs, one with global equities, one with global stocks. Combine them with a 1-to-1 ratio, and there you go. Right, it is a portfolio that generally, if you hold it for about 10 to 15 years, the odds of you returning more than 4% is extremely high. All right, and so it can actually function as something that can assist you in your journey towards financial independence. All right, so in conclusion, now we can actually, to get into our FIRE journey, build the simplest retirement portfolio consisting of one global equity ETF and one global bond ETF. All right, and you can put it with a 50-50 kind of ratio. All right, so this way you don't have to think so hard about things like asset allocation, and this can be done with any broker that grants access to the US markets. So in the evenings you can get your VT or your BNDW ETF from the stock market using DIY investing.